Hello. Welcome to our English lecture batch. Today we will be doing essay 324 from our 100-page audit summary and a small essay but important essay about materiality. So let's start. So now essay 320 talks about materiality in planning and performing an audit. That is, what will be my materiality level? How will I determine it? So now you need to understand there are two types of materiality. One is your planning materiality, second is your performance materiality. If your planning materiality is this, your performance materiality will always be lower than your planning materiality. Okay. So materiality is subject to professional judgment. There is nothing being defined as what is material and what is not. An auditor will have to use his professional judgment in determining whether is this material or not and what will be my materiality level. Your second point is discussion presented in financial reporting framework, that is your FRF, provides reference with respect to materiality. So if your financial reporting framework, suppose whatever Indias you are following or whatever you are following, if it says something about materiality, you can use that as a benchmark and then you can add minus or whatever as per you can use that as well. So that may provide a reference with respect to materiality. It will help you with the initial figure as to starting point. If it is not included, then following can be referred. So 3 points they have said that you can use these. First is the misstatements affecting economic decisions of users. You will have to identify as to what amount of misstatements economic users will still be okay, let go ki, this does not matter, this is not material, I am not affected by this. But whatever amount you determine that this at this point this amount economic decision will be affected of these users, you can set that as your materiality. That is misstatements affecting economic decisions of users. Second is your size and nature of misstatement. How big the misstatement is, that will also affect as to what will be your materiality. And last is your common financial information. Any information that is available in your financial statement, that will be your common financial information. You can use that to set your materiality. Now, as I told you, there is a second type of materiality, that is your performance materiality. Now, performance materiality is an amount less than materiality for financial statements as a whole. It is an amount of less than materiality than financial statement as a whole. That is what I told you is your planning materiality. One materiality you decide at the planning stage. While performing, you set a materiality level lower than your planning materiality to reduce to an appropriately low level the probability that aggregate of uncorrected and undetected misstatements exceed materiality for the financial statements as a whole. Now, what you are an auditor, you cannot identify all the misstatements that exist in the financial statement. There is a possibility you will miss out a few. You will not be able to detect a few of them. So they say that when you set your materiality, suppose planning materiality you had set as 1 lakh, that is all transactions equal to or over 1 lakh you will be checking. Any transaction less than 1 lakh you will not check. And you set your performance materiality as, say, suppose 80,000. So all the transactions that are between 1 lakh and 80,000, now you will be checking those also, right? So since you will be checking more transactions and more events which are approximately 80,000 in value, you will reduce the risk of not detecting material misstatements to an acceptably low level. Okay, easy. Now next is your auditor's duties. What are the auditor's duties? So there are two duties. First is, upon establishing overall audit strategy, he will have to determine what is my materiality. Once you check your audit strategy, you will have to decide what is your materiality. And second is determine materiality for specific transactions in which lower amount misstatement intends to affect economic decisions of users. So what you have, okay, but didn't we do this over here also? Where did we do that? Where did that go? Look, this point. Misstatements including omissions affecting economic decisions of users. What is the difference between this point and this point over here? There is specific transactions. That in specific transactions, my user might be more sensitive. So you will have to determine materiality for those transactions separately. So materiality for specific transactions in which lower amount of misstatement intends to affect the economic decisions of user, that everywhere else your user might be okay with 1 lakh, but in certain places like even 10,000 is a lot. So for those places, for those transactions, for those specific transactions, you will have to determine a lower materiality level. So this is your first point. What is your second point? Purpose of assessing RMM and determining nature, timing and extent of further audit procedure. So your auditor's duty is to determine the purpose of assessing risk of material misstatement, and he will also have to determine the nature, timing and extent of further audit procedures. Clear? So this is his, basically it is three duties where determine has 2 points. Now next is a revision of materiality. Now this revision is not the revision that you are thinking. This is not the revision that you do while studying. Revision of materiality is once materiality you are set at the planning stage. Now if during the audit you get to know about some more information because of which you have to revise your materiality, you will have to revise, either increase or decrease whatever, but you will have to change your materiality. That is your revision of materiality. Okay. So if the auditor becomes aware of information that would have caused auditor to determine a different amount initially, that is if he would have known this information prior while during the planning stage, then he would have determined a different materiality level. In such a case, he can revise materiality for financial statements as a whole, and if required for particular classes of transactions, account balances and disclosures. Okay, so he is allowed to revise materiality. If auditor concludes lower materiality than initially determined is appropriate, for example, initially the auditor had decided that my planning materiality will be 1 lakh. Now he says that no, my materiality should be 60,000. I have come to know more information. I have revised the materiality to 60,000. Now what you should remember is in our example, our performance materiality was how much? 80,000. And we know that your performance materiality is always less than the planning materiality. So over here, since this is 60,000, my 80,000, that is my performance materiality, should be less than my planning materiality. So you'll have to determine whether necessary to revise performance materiality also, that is because of my planning materiality change, do I also have to revise my performance materiality, and whether my nature, timing and extent of further audit procedures remain appropriate or not. That is because of change in materiality, will my nature, timing and extent of the further audit procedure that I do, will that change or will that remain the same? And last is your concept of materiality, that is how is materiality determined. I'll just erase this to make it a little clean so that we can read it. Yeah. Okay, so concept of materiality. So it is a percentage is often applied to a chosen benchmark. Now suppose I say I have determined the materiality to be 5% of sales. Now my percent over here is 5% and my benchmark chosen is sales, because I said 5% of sales. So this is my benchmark. Now how did I determine sales? So we have factors which will affect that decision. Is often applied to chosen benchmark as a starting point in determining materiality for financial statement as a whole. Factors affecting identification of benchmark, that is how did you identify that 5% of sales? Why not 5% of, say for example, assets, or 5% of profit? So these are your 4 elements. First is your elements of financial statement, that is what all elements you have in your financial statement, what all transactions you have, on that basis you will decide. Second is nature, life cycle and industry in which it operates, that is the entity's nature, life cycle and industry. C is ownership structure, what is the ownership structure of the entity and how is it financed. And your last point is relative volatility of that benchmark. Volatility is how much it fluctuates. For example, your fixed assets might not fluctuate that much, but your sales might have a volatile effect. Okay, so these are the factors that affect your benchmark, that is how you decide on what percentage, on what thing am I going to apply the percentage. That thing is called benchmark. And with this we are done with this essay, that is essay 320. Great, so I'll see you in the next class, that is in that class we'll be doing essay 330.